Let's now turn to the advisory. Since the tariff pause on Trump's Liberation Day, confidence has returned to the markets. Let's catch up with David Leon, founding partner at Stellan Capital. David, welcome back to AusBiz.
Thank you, Andrew.
So we've just been talking about how equity markets are performing, obviously locally. We've set a new record. The US market not far away from records. What is this confidence we're seeing among investors at the moment?
Look, it's very interesting, right? So U.S. equities are having their third biggest inflows in a decade. So obviously there's been a bit of confidence rattling, but largely markets are flying back. The other thing that I think is worth noting is that institutional investors, but also ultra high net worth, they're looking at other asset classes, whether they're diversifying into other geographies. But the other asset classes that are very interesting are CPI-linked infrastructure, regulated utilities, toll roads, contracted renewables. Well, they all pass inflation straight through to their various price formulas, and they're almost an inbuilt tariff-driven CPI hedge. So we're seeing a lot of movement there. We're seeing movement in the equity markets around data centers, hyperscalers and big tech. They have not pulled back as the media may have portrayed, and really on track to spend well over 300 billion US on AI and cloud capex. So Next DC has been a good mover here locally. Equinix overseas. Those have been some very strong movers, both in the unlisted and listed markets.
So overall then, David, what are you seeing with those high net worth investors and the sophisticated investors? What assets are they actually chasing then at the moment?
Well, aside from the infrastructure and data center plays, the other one that's very popular is floating rate, maybe private credit. So senior secured loans are still clearing 5 to 6% over one of the standard benchmarks. So that's roughly about 8 to 10% all in. So we're seeing a lot of actually high net worth clients very happy to trade in 4.5% cash yields, or lower today, for that extra spread. So it's there, but in particular, data centers and infrastructure getting a lot of attention.
All right. In fact, there we can see with that data center demand. All right. So now, interesting also just in terms of data, we've got jobs report, we've got CPI in the States out tomorrow as well. What should investors make of those numbers, do you think?
That's right. So last week, payrolls, 139,000 up, unemployment sitting around 4.2%, hourly earnings, about 3.9% year on year. This is basically the classic slow but steady Goldilocks print that you kind of hope for, especially given everything that's happening in the United States. Growth is cooling, but it's not collapsing. So most institutional investors they're staying long equities, as that original chart showed. Record inflows into U.S. equities, but global equities for that matter. But the general feeling is that investors are keeping some dry powder, particularly in case the Fed maybe later this year cuts interest rates. And that could also, your previous commentary around the Aussie dollar and US, that's going to have an impact there too.
All right. Well, speaking of the US dollar, what are the implications, particularly given the debt position in the States?
Yeah, that's right. So Moody's just pulled the AAA rating for the U.S. They were the last standout. And for the first time in history, interest payments for U.S. debt's going to top over 1 trillion. So look, this doesn't mean default. The U.S. is 100% in control of its own money supply and will never not make an interest payment, but it is having an impact on the U.S. dollar. It's trading near a low 3-year, but it's still within that band. It was actually lower in 2021, the US dollar. So we think that quite possibly investors or the media are overplaying the fears here. But the real issue is that, are investors abandoning their US investments or the greenback? We don't think so. We think they're just actually factoring in more inflationary risk into valuations. And that's really what we're talking about. There's also some speculation that China might be lightening up on its treasuries, therefore would have to sell US dollars. We're seeing precious metals across the world, which again could be net buyers, could be China, reallocating its US dollars into other asset classes. So we don't think necessarily it's a run for the hills thematic, but people are watching it, right? GDP potentially 134% by 2035. These are big numbers, but not quite where the U.S. Is at risk of defaulting.
Now, other things that people are watching at the moment has been that bust up between Donald Trump and Elon Musk. It was hard to take our eyes off that. Other than entertainment value, what are the perhaps investment implications of that?
This is the world's most important bromance, and it has hit the skids. Yeah, so most people know Musk blasted Trump's 1,000-page tax and spend bill because it basically scraps the U.S. $7,500 EV credit, which is obviously a direct hit to Tesla's interests. It also adds about 2.4 trillion to the deficit over the next 10 years, which technically undermines exactly why Musk took on Doge, right? So then Trump barks back, threatening to cancel SpaceX and Starlink contracts, which would be very difficult. They have such huge leads over the competition. It would be pretty detrimental to the US. But the reason this war of egos matters is that if Trump does kill the EV credit and global EV adoption slows, this would be bad news for Australia as it supplies multiple critical minerals to the sector, including hard rock lithium. So we are going to get caught up a little bit in this bromance breakdown, but hopefully it's not going to be too much.
All right. Okay. Now, you've also mentioned, obviously, in terms of perhaps thematics that investors are watching for at the moment is AI, which continues apace in terms of development, in particular, agentic AI. I think we've spoken about this before. So
Yeah.
if you're looking for investment opportunities, where do you need to look?
So for those not quite as familiar, this is earth-shatteringly bigger than generative AI. Okay, so ChatGPT was never going to replace a human job, but agentic AI has the potential to replace millions. So generative AI is like ChatGPT, only creates a response after a prompt, but agentic AI, well, it can anticipate, plan, execute multi-step tasks alongside you while you're working. So think of this as a very smart Harvard grad that could be your executive assistant that never goes to sleep, never takes a holiday. Now, some conservative market forecasts see AI, particularly in this agentic space, annual spending increasing from 7 billion today to over 40 billion over the next 5 years. That's over 40% compounded annual growth rate. Now, this isn't really important, right? Because on the backs of like stars like Nvidia, who've recently announced their own GPUs, have had training time for huge models, you're seeing the implication on data center sentiment, right? So next DC, Goodman Group, local heroes, but we got a whole bunch overseas, largely driving US markets higher. And that's, if you think about the US markets rally up 20%, 30% NASDAQ, S&P 20% from their lows, 80% of that lift has been really driven by the Magnificent Seven and your critical hyperscalers, Microsoft, Amazon, and Google. So this is absolutely huge. So I think the thing here is that you have to really be focused on not only the CapEx that's going into this space, but what is likely going to be transformative, both at a society level, but also for markets. Where are you going to find that depth in investment opportunities? Unfortunately, short of a couple names like Wise Tech that is using and experimenting with AI, you're largely going to find that overseas.